Have I frozen? Oh, right, okay. Good afternoon, everyone. Welcome back to Avon Pension Fund Investment Panel. We've just been discussing item 8 on the agenda, which paper. So I'd like to ask a member of the committee to move the recommendation as printed on page 1, recommendation 2.1 on the paper.
Happy to move that, Chair.
Thank you very much, John. And a seconder?
I'll second that, Chair.
Thank you very much, Shirley. And I will take it that we are all in approval unless I see a message in the chat on Zoom that they are against. Nope. So we have noted item Avon's performance for the periods ending 31st December 2021, and our officer Nathan Rollinson will present the report.
Thanks, Chair. So just a quick note on performance before I hand over to Mercer then. So no concerns to flag with any of the Brunel portfolios this quarter. The high alpha portfolio did underperform its benchmark due to its relative positioning in the tech sector and its tilt to growth style stocks. So the underperformance there is well understood. The sustainable equity portfolio posted strong absolute and relative returns, and real assets tended to perform well, particularly UK property and infrastructure. During the quarter, the transition from the legacy low carbon fund into Brunel's Paris aligned fund completed, as did the exit from emerging market equities, with proceeds there reallocated into the high alpha portfolio. The residual balance in the low carbon fund, which is about 200 billion, will be switched into the sustainable equity fund by the end of the current quarter, which will conclude the implementation of the changes agreed at last year's equity review. And then just finally, given the sort of recent volatility we've seen, there has been this shift in equity markets to economically sensitive stocks and away from growth style stocks. And as a result, our equity portfolios are expected to struggle in this kind of environment. However, as we've already kind of spoken about briefly, the DRF and MAC portfolios are holding up very well and providing the diversification benefits as intended. So maybe if I just pass over to Mercer. Steve, I'm not sure if you're doing this, but can you take us through your various papers?
Josh is going to do this one.
Okay.
I'll just share my screen if I may. Okay. So yeah, I'll just talk through our Q4 report, and obviously, as Nathan said, given recent events, this is somewhat historical, and we'll talk a bit more in detail about sort of the forward-looking outlook, particularly in relation to the inflation position later on in the agenda. But just looking back at Q4, hopefully you can see the executive summary of our report there on screen. Q4 was fairly challenging. There's a number of obviously factors going on. So we had the continuing stretching of global supply chains, interacting with the new Omicron variant of COVID-19, however, which obviously, as everyone will be aware, turned out to be far less disruptive than previous variants. So overall, growth assets did reasonably well, particularly in the face of increasing inflation expectations, which actually for the portfolio itself turned out to be a positive driver of returns as well. So forward-looking market views, as at the time of writing this report, we were fairly optimistic about 2022. And actually, as I say, we'll come on to in a bit more detail later on, but we still think that the global macro backdrop remains supportive. We still think there's growth there for developed markets in particular, and obviously inflation is a big issue that we need to be aware of. But the fund remains relatively well hedged on inflation, and from a growth market perspective, the equity protection strategy is certainly doing its job. And as we'll see when we get some reporting through for Q1, actually to date, though the equity protection strategy has going to positive territory, offsetting some of the falls that we've seen from the underlying physical holdings. In terms of the funding level, so over the quarter, there was an increase to around 102%. So the asset growth, as I mentioned, outperforming the liabilities, which increased largely as a result of inflation. And over the year to December, around a 7% increase. The value at risk rose to just over 1.2 billion. Now that's at the strategic level. As you'll recall, there was an agreement to amend the investment strategy to have slightly more in equities and a bit less in the diversified returns fund. So it's broadly return neutral from a strategic perspective. That does result in a slight increase in modeled risk. That said, that's based on the strategic allocations. The actual allocations remain slightly below that. So actually, overall, we didn't see a dramatic increase in the risk position. In terms of returns, Nathan's already commented there on the performance of the main portfolios and the drivers there. At the total fund level, you can see a return over the 3-month period of 3.6%, which was slightly behind the strategic benchmark. As has been the case in most quarters recently, that's predominantly due to the drag from the equity protection strategy, as equity markets have done well. There's also the underperformance from the Brunel Global High Alpha Fund and some of the other portfolios in there as well. In terms of asset allocation and strategy, Nathan's already covered the majority of those points. Worth noting that at quarter end, all of the asset classes were within the rebalancing ranges, with the exception of the renewable infrastructure and private debt. Just as we've discussed with Brunel, they are still in the process of being drawn down. In terms of the rest of the report, just a couple of points I wanted to highlight were see the risk decomposition here. You can just see the slight increase here in the equity risk in the red bar, but slightly more offset proportionally by the equity options, showing that overall increase. And also something else that we've added into our report from this quarter on slide 22 is a chart showing the attribution of performance over the quarter. And this is always just worth having in mind, just to illustrate the sort of spread of where those returns are coming from. And clearly the headline here is that the majority of returns have come from global equities, and that offset from the equity protection is a relatively small piece of that. All of the other asset classes contributing positive in absolute terms, albeit some of them have outperformed and underperformed their respective benchmarks within it. So the intention would be to include this in our reports going forward, but also to see if it's feasible to build up a longer term track record of this using data from your custodian as well. Conscious of time, the other section here looking at performance of the various portfolios relative to the strategic expectations that were set when the strategy was put in place around March 2019. And the majority of the asset classes have outperformed those expectations, which is what's partly driven the increase in the funding level. So you can see all of the equity portfolios, the diamonds are above the bars, which means that returns since that period have been above your expected returns. The emerging markets portfolio is worth mentioning. That dipped slightly below during Q4, but that was actually terminated during the quarter. And the remainder of the portfolios here, a bit of a mix depending on the various asset classes, but by and large, on the whole, actual returns have been above expectations. That was all I was going to cover, unless there's any other questions on the report.
Thank you very much, Joshua. And
Sorry, Chair.
Shirley. Shirley?
Yeah, sorry, was Liz wanting to?
No, go on, by all means.
Okay, thank you, thanks. It might be a question that you can't answer just, but in terms of looking at the value at risk, or looking at the 1 in 20 occasion, if you like, what the impact might be. And would you say that potential war in Europe is a 1 in 20 risk? It just feels like we're on the cusp of something that could be have significant effect on our investments.
So it's quite difficult to say in those terms. I mean, COVID in 2020 was a more than 1 in 20 event, and then clearly we've had a few of those in the last couple of decades. So I think what I'd say to that is, rather than only looking at value at risk, I think for these sorts of scenarios, it highlights the importance of scenario modelling and stress testing the portfolio in those sorts of ways. And actually something we'll be looking to do, which we'll be working with Liz and Nathan on very closely over the coming weeks and months, is for the strategic review off the back of the actuarial valuation, is looking to do some of that testing on the portfolio as well. So, modelling the impact of certain outcomes to see how robust it is in those real world scenarios. The other thing in terms of 1 in 20 is that this is a combination of the worst case scenario across a range of asset classes, as opposed to any one in particular. So
sure,
it could be particularly bad for European equities, but other asset classes in the portfolio, it may not suffer to the same extent. Also combined with that is the equity protection strategy in place as well, which is specifically there to provide a buffer in these sorts of instances.
Yeah, no, that's good. I think the scenario testing would be really helpful, because it always feels to me that we are in such a strong position from a funding perspective, and it's always whether we're doing enough to actually review that for the future. While we're in a strong position, are we doing enough to make sure that we're protecting ourselves, for things that are going forward? But that's helpful anyway. Thank you.
No, Shelley, we always need to try and strike the balance. You can't take a very low level of risk, because otherwise you wouldn't get the returns that you need to support pensions. But I mean, having the dynamic equity protection strategy, we think should be a massive comfort in the current environment looking forward, because it will evolve with market levels, and it should perform a lot better than, say, a static strategy. Even before developments this week, markets to us felt pretty fragile because of the cross currents of potential impact of rising rates because of higher inflation and the build-up of this tension. And so, I mean, you can easily imagine scenarios where things really escalate, particularly if sanctions on Russia become really harsh and they essentially sort of turn off the gas taps, as it were. That could be just really damaging to economic growth as well. So we'll have to sort of wait and see. But the good news is that you do have this equity protection strategy in place. So that's not going to cover everything, but it's gonna just allow you to sort of sleep easier at night, I think.
Yeah. Okay, thank you.
Thank you much, Joshua. I don't see any other further questions at the moment. Is there anything else you wanted to highlight in your report before we move into exempt session?
No, that was everything from me. Thank you, Chair.
Thank you very much. So, I'm afraid to members of the public, we will be going back into exempt session now if the panel agrees that, having satisfied the public that the public interest would be better served by not disclosing relevant information, proposes, in accordance with the provisions of Section 100A4 of the Local Government Act 1972, that the public should be excluded from the meeting for this item of business because of the likely disclosure of exempt information as defined in paragraph 3 of Part 1 of Schedule 12A of the Act as amended. Everyone is in favour of that, and then we will be able to discuss appendix item 4 and 5 in exempt session. I'm seeing no public, and we will move into